There's a risk associated with it where we probably assume that the IPO may go unsuccessful. To mitigate the risk, investment banks actually underwrite an IPO, which means that if there is an undersubscription, then investment banks will actually buy those shares. Now let us discuss another important function of an investment bank when we talk about IPOs. That is called as underwriting. So we have been hearing a lot about investment banks doing underwriting for various IPOs. What exactly it means? So let's take an example here in order to see what underwriting means. Let's see that there's a small company that is a private company, and they want to kind of raise new securities. So we have discussed this earlier. They may raise using an IPO, or the initial public offerings. But the problem is that there may be a risk associated with undersubscription. What this undersubscription would mean is, let's say this company wanted to raise $100 million from the market. The risk of undersubscription means that whatever they wanted to raise, they may not be able to raise. So not 100 million, maybe they are able to raise 50 million. That's undersubscription. There are investment bankers who basically underwrite the securities and help the firms raise the committed amount. So what this means is that if an investment banker is underwriting these securities, he is virtually guaranteeing that the amount that is committed to be raised will be raised. And how does the investment bank actually ensures this? So essentially, when the IPO actually comes, so the stocks are given to the investors, and let's say if there is under subscription of any kind, let's say to an extent of $10 million, so these $10 million worth of stocks will be absorbed by the investment bank. So we are essentially saying that the investment bank will actually buy these shares and sell that at an appropriate time in order to make a profit. So underwriting means that essentially you're guaranteeing that any amount of under subscription will be absorbed by the investment bank. And obviously, as you can see, that the investment bank is assuming a financial risk. The financial risk could be that let's say if the IPO was not successful, so the investment bank may have to buy this stock to an extent it was undersubscribed, and let's say the stocks tank after some time, so that's a huge risk for an investment bank.